Good day, fellow investors. Let's talk about real estate. There were many comments on various videos discussing how I could help you by doing a real estate outlook update and also discuss some REITs. And there was this great comment on Hershey. If the average consumer would listen to conference calls, there would be riots on how the management thinks about the consumer and things like that. Very, very nice comment, so I included it here. But let's go to real estate. Many of you were very thankful when I had been telling you to buy houses, to take 30-year fixed mortgages when mortgages were cheap and house prices were also much cheaper. So I started this YouTube channel in 2017, and I have been telling people that this mortgages below 4% is practically free money. Now the situation is much different. In the US, mortgages are at around 7%, and house prices have come down a bit, but just 13%, and are still 50% higher than in the 2010s, which is something still crazy. And therefore, buying a house now in the United States isn't as smart as, let's say, a sure thing as it was a few years ago. Let me discuss the comparisons so that if you're thinking about something like this, you can see how it fits you. At the end, if it's not an investment, if it is a house, then it's likely to be there in line, depending on the cities, the properties you are looking at. Somewhere the rental yields are around 8%, so you don't gain, or if there is much more inflation in the future, you will gain, but that's the name of the game. Let's compare just the prices, what should happen to real estate with mortgages going from 3.5 to 7.1. If I take a home loan of $500,000, then at 7%, the mortgage payment is $3,785. However, the same mortgage, the same $500,000 mortgage on 3.5, the mortgage repayment is just $2,670. So this is a huge difference when it comes to buying a house, and therefore houses should be much cheaper, because the question is not what are the prices, but when you're buying, how much house you can afford. And for $2,670, that was $500,000 mortgage payment a few years ago. If I put that into a 7.1% interest rates, then home values that you can afford for the same monthly payment goes down to $335,000 or 33% down. If we look at real estate prices in the US, those are down just 13%. This means that the market is still pricing in lower rates to come soon. That might not happen. Therefore, there is still plenty of room for real estate prices to adjust to, let's say, more normal levels. And with mortgages at 7%, home prices should be 30% lower, but maybe not even 30% lower from this level, 30% lower from the 220 level, which means that home prices should be half of what they are now. But yes, everyone is expecting lower rates, inflation, and therefore betting on the safe investment as real estate is considered. When it comes to interest rates, it's impossible to predict. We cannot know whether interest rates will go up, so if you wait now not buying a house for lower rates and then rates go up, then you have lost that opportunity. So you have to make the calculation, not predicting on what will happen, just how it fits you. Over the long term, inflation should benefit you. Inflation will be on average 3-4%. It's not 7%. Maybe there will be hyperinflation, but that then is also a positive that you never know when that positive might come. But okay, if you buy a house, if you're happy with that house, and then rates go lower, well, that's also part of life. You cannot win all the time, always, anywhere. So currently priced into real estate, rates will go down, the government will save all house owners, debt owners, and that it is a good inflationary protection asset, and therefore prices are still holding. On a question, would I buy a house now? Depends where and depends what I'm buying. If you look at the market, there are always deals to be found, interesting things, solutions. So depends also on how much effort you are putting in. But if the rental yield is equal to the mortgage interest rate, then and the mortgage payment that I should make for the house, then I would first look for buying a house, because in the next 30 years, there will be higher inflation, which will then help you as a tailwind over the very, very long term. And your fixed mortgage payment now will look ridiculous in 10, 20 years. So, therefore, it is still time to buy a house if you like something. Now, it might not be a great time to buy it as an investment, because you never know what can happen, and 7% is a high yield, higher than the rental yield. So as an investment, it might not be a great idea, but as a house, it's a house, and you might be down for a few years, 5, 10 years, depending on how home prices adjust. But over the long term, the benefits there should be, let's say, positive on the whole. And if I look at the Netherlands, mortgage rates are still where those were. When I bought the house, I think I had 3.55 for 20 years. That was back in 2015. So nothing wrong there. Of course, prices went 2x since I bought the house, but these are not terrible interest rates. Any mortgages below 4%, 20, 30-year fixed-term mortgages, those should make you money. That's still free money given the situation with inflation. 7%, you pay a yield. Okay, that's again 4% inflation, 3-4% inflation, you pay 3-4% real returns. Over the long term, it should still be okay. But yes, house prices are 50% higher than a few years ago, so that is a bubble. But then again, waiting that the bubble will burst, that's an impossible task, an impossible feature. And yes, it might happen. Home prices might go down 40-50% depending on where, but betting on that, you can wait, enjoy your life, and then if it happens, okay. But if you want to buy a house and you go into the waiting game, you could wait for 20 years and be still waiting. So the key is, whatever option you have that you are okay with it, then it is maybe smarter to wait. But if you want a house, maybe it's better to buy it. You can never know these things. I know that US housing is priced at 4% mortgages, so that is something to think about, especially not as an investment. But again, you never know where will home prices go in the future. And then a question about Reits. What's going on? Punished stocks. Well, I did a video on Reits a few months ago, 5 months ago, half an hour, detailed explanation of all you need to know, the factors to invest in Reits. So watch that before anything else about Reits. And let's just check this. Yes, Prologis has been punished. It's down, what is this, 40%. But if I look at where it was, it's still up, plus the dividend that we're paying. So it has been punished relatively to previous zero interest rates real estate prices, and now it still hasn't adjusted to 5.5% real estate prices. And then they are investing all the time. But look at this. This is the number of shares that they have issued. They have constantly been issuing equity to grow. And yes, the stock followed and they have been issuing, but they are still buying those properties at market rates, there are no competitive advantages there. The book value per share grew just because of equity investments, and you can see that earnings per share grew, but not even that fast. It is actually also a little bit volatile, so I don't know whether there are asset sales included there. And we have not seen a real recession for 15 years, a real recession, and that is also a risk to think about when it comes to REITs. For a dividend yield of 3%, for growth on debt and equity, you can see here the long-term debt has 3x in the last 7-8 years. That's not something that I would categorize as a great investment now. The dividend, yes, 3%, but not something special in the current environment. Rexford Industrial, again, logistics, etc., etc. No recession, high investments. Very, very difficult to do at these yields in the current situation. So again, check that REIT video, and if you want better, I think you can just check the names on my research platform, do the research there, and see that there are much better yields, much better growth, better margin of safety than these highly levered financial engineering. So when it comes to real estate, again, see how it fits you. REITs still a no-go for me. So that's it for that video. Tomorrow we'll discuss the markets and then go to value investing.